Welcome to the YCharts Economic Update for Q3 2024. In this short video, we'll recap the top market and economic storylines that defined the past quarter. The visuals in this recap are from our comprehensive economic summary deck. The deck is free to download by heading over to get.ycharts.com or clicking the link in the description. In this quarter's recap, we'll cover asset class trailing performance, market valuation measures, mortgage rates, treasury yields following the Fed's September rate cut, and volatility during election years. Let's dive in. First up is market data with our heat map of asset class performance over trailing periods. Real estate took the crown in Q3 with a 17.1% total return, more than covering losses from the first two quarters of the year. U.S. value came in second at 9.4%, followed by small caps at a close behind 9.3%. The lone loser was commodities, which sank 5.3%, largely in part to WTI crude oil prices plummeting 17% in Q3. With several asset classes posting double-digit year-to-date gains, it raises the question of what is the impact of rising asset prices on market valuation? Let's look at a key metric. The S&P 500 cyclically adjusted price-to-earnings ratio, or CAPE for short, rose slightly to 35.23 as of quarter end and is nearly 4 points higher year-to-date. The CAPE ratio is currently more than double its historical average. For context, this is the third highest CAPE ratio dating all the way back to 1881. The highest CAPE ratio on record was at the height of the dot-com bubble, and the second highest was 38.5 in November 2021, which preceded the bear market of 2022. Shifting to macroeconomic factors, the talk of the town in Q3 was the Fed's half-point rate cut in mid-September. Naturally, Fed funds rate movements have a major knock-on effect when it comes to mortgage rates. Both the 15 and 30-year mortgage rates dipped lower toward the end of Q3 after the FOMC meeting on September 18th. The 15-year mortgage rate closed out Q3 at 5.16%, dropping 109 basis points in the quarter, while the 30-year shed 87 bips in Q3 to end the quarter slightly above 6%. The prospect of lower mortgage rates has helped spur an uptick in mortgage originations. There were $429 billion worth of mortgage originations in Q2, which is the latest data available, representing a 13.8% quarter-over-quarter change. How much effect will the Fed's rate cut have on mortgage originations going forward? We'll have an idea on November 15th when Q3 data is released. Speaking of rate cuts, the Fed's move in September caused Treasury yields to plummet across the board. Both the one-year T-bill and two-year note suffered triple-digit basis point declines in Q3, and all maturities ended the quarter below 5%, including the one-month T-bill. One notable headline was the 10-2 yield spread normalizing for the first time in over 2 years. Why is this important? Well, the 10-2 had been inverted since July of 2022, and an inverted yield curve has typically preceded previous recessions. Many are wondering if and when a recession will strike, and you'll find more insights on recession probability in the full economic summary slide deck, so be sure to download the deck if you haven't already. Lastly, our chart of the moment from this quarter focuses on historical volatility during election years. This visual is from YCharts' election guide on how do presidential elections impact the market. The purple line illustrates average daily VIX levels during presidential election years since 1992, while the yellow line shows daily VIX values between May and September of just this year. Investor anxiety has generally risen leading up to Election Day, but volatility often cools down once the election is over, and in the roughly 2-month period leading up to Inauguration Day. So far this year, the VIX has spiked a couple times since May, but as of quarter end remains below its average level over the last 8 presidential election years. So for any advisors out there with clients concerned about the election's potential impact on their investments, know that the waters tend to grow calmer after Election Day. Thank you for watching this Q3 economic update. For more detailed insights and to recreate these charts with your firm's branding and logo on them, visit our website at ycharts.com or send us an email at hello@ycharts.com. We'll see you in the new year for our Q4 economic update.